Hey everyone, welcome back to Corporate Decoder. Ever wonder what a big company's quarterly report is really saying? Today we're diving into Cimpress's latest financial report. Think of it like trying to read a map written in another language, except we're here to translate. And trust me, there are always a few surprises hiding in the fine print. Cimpress, a company that specializes in customized printing, just released their financial results for the period ending in March. The big story? Revenue only increased by 1% compared to last year, hitting $789.5 million. Don't let the slight increase fool you, there is much more to discover. First stop, the balance sheet, which is basically a snapshot of what the company owns and owes. It shows their total assets are at $1.878 billion. A key number to focus on is the total shareholders deficit, which is negative $500 million. Meaning they owe more than they own. But this didn't stop them, since they still had about $187.8 billion in cash. Now let's scroll down to the income statement, also known as the profit and loss statement. Here we see they actually lost money this quarter, showing a net loss of about $8 million. It's not great. However, if we look at their performance over the last 9 months, they have earned about $41 million. So the most recent quarter might be an outlier and not the standard. Another important metric is how much money they made per share. This quarter they lost $0.33 per share. This means that for every share of stock someone owns, the company lost 33 cents in value in this time frame. However, once again, over the 9 months the value is positive, making 1.61 per share. It's time to check where the cash came from and where it went by looking at the cash flow statement. This shows that they're bringing in less cash from their day-to-day operations compared to last year. Now let's look into any potential problems for the business. Under commitments and contingencies, the business discussed some programs they have set up. A good move by the company is having all their employees sign non-compete agreements. It protects the company from intellectual property theft. Time to look at the item 1A. Risk factors section, which reads as a list of all the things that could possibly go wrong. Here, the company acknowledges that their financial results often fluctuate, which can cause their stock prices to go up and down. There's some risk from global operations with political instability and fluctuations in currency prices. One point of note is the increased raw materials and supply chain disruptions that the company says could impair their ability to source and fulfill product orders. The risk from tariffs is also discussed. In the unregistered sales of equity securities section, we learn about their stock buyback program. Basically, the company is buying back its own stock. The final notable point is their debt. They took some new debt which they used to pay off some of their old debt. As of March, their long-term debt sits at about $1.5 billion. So what's the overall picture? The company is dealing with some headwinds. While the financial report has had its ups and downs, the business has a strong base that allows it to continue, although some risks persist. But ultimately, their direction will depend on navigating current risks. Remember to do your research before making investment decisions. If you have found this content helpful, please like and subscribe. Thanks for watching.